This is a question on investment allowances extracted from CPA Section 2 in May 2021. It reads as follows. Plasticom Limited is a company established in the year 2020 to manufacture plastic products. Before commencing operations on 1st May 2020, the company incurred a total of $8,760,000 in construction of factory building, which included go down, $320,000, showroom, $240,000, administrative offices, $680,000. The treatment of this first part is that the factory building qualifies for initial decelerated allowance at 50%. But the three showroom, go down, showroom, and admin offices do not qualify for the decelerated claim in the first year of use. And therefore, they need to be separated from the factory building. But before doing this, we always need to confirm that the aggregate value of the non-qualifying parts are at least 10%, meaning 10% and above, then they need to be separated. In case they are less than 10%, then they don't need to be separated. They qualify together with that particular building. So in this case, we need to determine the total of the three. And to determine the total of the three, we need to add the value of 320 plus 240 plus 680. And if we add the three, the value becomes a total of 1,240,000. Divide that by the total construction cost of the admin offices of the factory building, which is equal to 8,760,000. Then multiply by 100. And if you do that, then what you get is about 14%. 14% is greater than 10%. And because of that, then it therefore means that the three non-qualifying parts need to be separated from the factory building. So the qualifying value of the factory building then will be 8,760,000 minus 1,240,000. So that is the qualifying cost of the factory building in this case, because we need to separate the non-qualifying parts from the factory building. Next, we are told in the additional information number 1 that the following assets were constructed and utilized with effect from 1st July 2020. The date in this case will not be significant because we are not calculating proportionately depending on when the asset was acquired. So therefore, the date is not significant in that case. We just need to analyze the assets for what they qualify for, starting with water pump. Water pump will qualify for 50%, and then in the first year of use 50%, then it qualifies for investment allowance or reducing balance method. Labor quarters do not qualify for the first 50% in the first year, but it just qualify for 10%. Processing machinery qualifies for the 50% in the first year of use, after which it qualifies for investment allowance on reducing balance method at 25%. The tractor does not qualify for 50% in the first year of use, but qualifies for investment allowance at 25%. Scanners do not qualify in the first year of use for 50%. It just qualifies for 25%. Two saloon cars also do not qualify for 50% in the first year of use. Also, forklift do not qualify for 50% in the first year of use. Computers do not qualify for 50% the first year of use. Power transformer qualifies for 50% the first year of use. The reason here is that this is a manufacturing company, and therefore power is generated for that purpose. Cabinets do not qualify for 50% the first year of use, but qualifies for 10% investment allowance. Boilers qualify for 50% the first year of use because it is a part of the manufacturing equipment. Then the next one is bridge connecting the factory to the main road. The bridge qualifies for 50% the first year of use. This is one of the civil works which are used together with the factory building, and that is why it qualifies. We are also told that the following costs were incurred on 1st September 2020. Sinking borehole. Borehole is for water supply. For in a manufacturing situation like this, it qualifies for 50% in the first year of use. Construction of parking bay. Parking bay is civil work which is part of the factory building and therefore also qualifies. We are told that one of the computers was traded in for another on 10th of November 2020 for a new one at 68,000, and the trading value for the old one was 40,000. So a new one was acquired at 68,000 and old one was disposed at 40,000. Both of these do not qualify for 50% the first year of use, but they qualify at 25% in reducing balance method. The company constructed sports pavilion and additional staff quarters during the year at a cost of 890,000 and 1.2 million respectively. Both these do not qualify for 50% the first year of use, but they qualify for reducing balance method at 10%. These are buildings which are used for staff welfare. We are required to determine investment allowances due to Plasticom Limited for the year ended 31st December 2020. Now, to determine this, then this is what we need to do. We need to prepare a schedule for calculating the investment allowances. The schedule for calculating investment allowances. The schedule is prepared as follows. So just want to put everything together in one schedule so that it is easier to determine, because otherwise we need to use separate schedules to calculate various allowances. But in this case, I would like to use one so that we can see everything all put together, and that is easy to follow. Now we start with qualifying costs. Qualifying cost of the asset. And then we have decelerated investment allowance. Decelerated investment allowance, which is always calculated at 50%. So decelerated investment allowance is 50%. That is in the first year of use. Then accelerated investment allowance, that is the one on reducing balance method. But this is the rate of 25%. Then accelerated investment allowance, still reducing balance method. This is 10%. So having discussed each and every asset in the question, we want to now put it together in this particular schedule so that we come up with the investment allowance for the year 2020. Start with factory building. And we said that the factory building, qualifies for initial investment allowance at 50% first before 25% on reducing balance method. So the cost of this that qualifies, we determine from here. 8,760,000 minus 1,240,000, and that equals to 7,520,000. 3,760,000 is a 50%. The remaining 50% is 3,760,000, which now qualifies for allowance at 25%. There is none that qualifies at 10%. The other assets include go down, and go down only qualifies at 10%. There is no initial 50%. So we classify that under 10%. Showroom, the same way. Under 10%, 240,000. Administration offices, also the same. Administration offices, also 10%, 680,000. But first, we need to determine the qualifying cost by adding the qualifying cost here. Qualifying cost is the first item we need to put, because qualifying cost is what will determine for us what we are going to calculate allowances on. The next is water pump. Water pump is 540,000. And it qualifies first for initial investment allowance at 50%, which is equal to 270,000. The residue will qualify for accelerated deduction at 25%, which is 270,000 also. Labor quarters is the following. And labor quarters qualify for investment allowance at 10%, reducing balance method, 920,000. So we classify that under 10%, 920,000. Processing machinery. This is for manufacturing, and therefore it qualifies for initial allowance at 50%. So we start with 2.6 million here as qualifying cost. 50% of 1.3 qualifies for initial deduction or initial investment allowance. The remaining 50% qualifies for accelerated deduction at 25%. The next one is tractor. And the tractor qualifies for investment allowance at 25%, but without the initial allowance, because it falls in the class of motor vehicles. Because of that, it is direct to the class of 25%. Scanners, the same. That is in the class of computer and peripheral devices, and therefore it is qualifying only for investment allowance at 25% without the initial deduction. So we have 320 here. Tow saloon cars. Now for the two saloon cars, this is what we need to understand. Saloon cars are non-commercial motor vehicles. And being non-commercial, these motor vehicles are supposed to be added up to a maximum of 3 million per motor vehicle. In this case, we have two motor vehicles at a cost of 7 million. Therefore, if there are two, then each of them should be divided by 2 so that each of them is equal to 3.5 million per motor vehicle. If each is 3.5 million, then we need to restrict the value that should be added up to 3 million only. Therefore, the value that should be added is 3 million multiplied by 2, so that these two saloon cars will be only 6 million and not 7 million. It is because we have restricted the value of each car to 3 million. We have divided the total cost to determine the cost per vehicle. The cost per vehicle is 3.5 million. But then, being non-commercial vehicles, the value should be restricted to only 3 million per vehicle. So we have 3 million multiplied by 2 to give us 6 million. So we have a total of 6 million there. And these vehicles only qualify for accelerated allowance at 6 million and not decelerated investment allowance in the first year of use. The next one is mobile forklift, which is 1.5 million. $1.5 million, and this also only qualifies for accelerated deduction at 25%. So 1.5 million. Next is computers. There is no initial deduction for computers. 250. It qualifies for reducing balance method. 250,000. Power transformer, and power transformer has initial deduction because it is used to generate electricity for manufacturing purposes in this case. Therefore, that is why it qualifies for the initial deduction at 50% before it qualifies for reducing balance method at 25%. In this case, we're going to have 820,000, which is the value of the power transformer or the cost of the power transformer. First qualifies at 410. That is the initial allowance, after which the 410 remaining will qualify for reducing balance method 25%. The next one is office cabinets, and office cabinets are part of furniture, and therefore office cabinets only qualifies for deduction at 10%. 180,000 only qualifies for deduction at 10%. The next item is boilers, and boilers here is for manufacturing, therefore qualifies for initial allowance. 960,000, and the initial allowance on these boilers is 480,000. Remaining 480,000 for reducing balance method at 25%. Bridge connecting the factory from the main to the main road. This bridge is important in manufacturing, and therefore it qualifies for initial allowance at 50%, which is 600,000. The remaining residue qualifies for reducing balance method at 25%. The next one is additional information number 2, where we are told that the following costs were incurred on 1st September. Like I said, the date will not be significant for them. We have a borehole and construction of parking bay. Both of them being civil works used in the factory are qualifying for the initial deduction before they qualify for reducing balance method at 25%. Now we have borehole at 720,000. So we have 360,000 here, remaining 360,000 for reducing balance method 25%. Parking bay, 630,000. So for 315 first, in the first year we use 315, and 315 remaining for reducing balance method 25%. In the additional information number 3, one of the computers was traded in on 1st November 2020 for a new computer at 68,000. The new computer which was received, we add, but then the computer which was given out in trading, we shall subtract. So start with the computer to add, which is 68,000. Computer only qualifies for reducing balance method at 25%. In number 4, the company constructed sports pavilion and additional staff quarters during the year at 890,000 and 1.2 million each. They were used from 1st October 2020. Now we add them also. Remember, these also qualify only for reducing balance method 10%. Sports pavilion. Sports pavilion, 890,000. That is under 10%, 890,000. 1.2 million, that is staff quarters. $1.2 million. 1.2 million, and that is also under 10%, 1.2 million. These are all the items that we needed to add. But then there is a disposal of a computer that we have seen in additional information number 3. So we need to dispose of that computer. Therefore, we add a section for disposal as follows. Disposals. And the disposals equal to computers. Computers. 40,000. No, we don't need to add it there. We just go direct to where it should be deducted. Computer should be deducted in this column. So we deduct here 40,000. And after that deduction, then we now need to determine the total and also determine the investment allowances, whereby the total for each and every column are as follows. The totals are as follows. The total for the first column, we don't need to get that. But the second column, we may need to get the total, which equals to 7,495,000. That is the total. The total for the third column is equal to 17,393,000. $393,000. And the total for the last column is 4,430,000. Now, these are the totals for each and every column. After determining the totals, we need to calculate the investment allowances. The investment allowances are determined as follows. For the first column, we have a total of 7,495,000, and that is the same as the investment allowances. So because they are calculated on once for all basis, and we already calculated 50%. So for the first column, this is the investment allowance. But then there is something that we need to consider, that this company commenced operations on 1st May 2020, meaning in the year 2020, the company did not operate for the full year. In a case where the company have not operated for the full year, if the business has not operated for the full year, then we need to calculate investment allowances proportionately. But if the business has operated for a full year, then we don't need to calculate any the investment allowances proportionately. In this case, the company operated from 1st May up to 31st December. Now, those are a total of 8 months. Therefore, what we're going to do is to multiply the investment allowance for that is beginning the second column of 25%. The one for 50% is charged at 50% the first year of use, and that is it. In the second year, we are going to have, so this is the first column, the one for 50% is what we have. In the second column for 25%, we're going to have 17,393,000 multiplied by 25%, multiplied by the number of months, which is 8/12, because the company only operated for 8 months. So multiplied by 8/12. So we have 17,393,000 multiplied by 25%, multiplied by 8/12. And that should give us a total of 200. That is a total of 2,898,833. 833. The last one is 443. The last one is 4,430,000 multiplied by 10%, but multiplied by 8/12, because the company operated for only partly during this year. That will give us a total of 295,000. So we have 295,333. That is because the company operated for only 8 months, beginning 1st of May up to 31st of December. So what we do, therefore, is whatever we have calculated, we need to bring them over here. The investment allowance for the first case is 7,495,000. Investment allowance for the second case is 2,898,833. 2,898,000. 2,898,000, and then 833. And this we need to subtract from the total. The difference is 14,494,167. 14,494,167. This is known as written down value. Which is carried forward to the next year. In the next column, we have 295, 333. Now we have 4,430,000 minus 295, 333. And that is a difference of 4,134,667. Now this is the written down value, and the written down value at the end of the year 2020 is the written down value at the beginning of the year 2021. Now we have determined the investment allowances, and we can also prepare a summary of the investment allowances where we get the total investment allowances. So the total investment allowances is prepared under summary of investment allowances. So this is the summary of investment allowances, where this is the decelerated investment allowance, and the others are accelerated 10% and accelerated 25%. Accelerated 10% and accelerated 25%. So if you want to determine the aggregate figure of the investment allowances, then you need to get the total of the investment allowances which you have calculated under each category, and that will be a total of 10,689,166. That is now the total investment allowances. Which is an allowable expense in the statement of taxable profit.